That is the ultimate lesson, is that funding equals freedom. I do not subscribe to the theory of find the deal and the money will follow. I do not subscribe to that at all. I subscribe to raise the money first, warm up the capital first, and then you have an unlimited amount of inventory and deal flow that you can run after. And I've learned that through this crazy experience of fighting pancreatic cancer. And so
Tim is one of the most authentic and genuine people I've ever met.
Sincerely believe he's coming from a position of giving, and that means a lot.
You're going to make huge progress.
Welcome everybody to today's Capital Raising Show. I'm your host, Tim Mai. And today I have an amazing guest on the line with us today, Josh Cantwell. I've known Josh, oh my goodness, long time, well over 15 years, that's for sure. Josh just have an amazing story. He started with single family homes like a lot of us, and went through a life-threatening situation, and somewhere along the way he got into this multifamily space and just blew it up. So I'm super excited to interview with him today. Josh manages over $40 million in private money, which he deploys into multifamily and apartments. He currently holds a portfolio of over 3,000 cash flowing apartments. He is the founder and CEO of a variety of successful businesses, including Freeland Ventures and Strategic Real Estate Coach. All right, with that, let's give Josh a big welcome, y'all. Woohoo! Okay, Josh, let's start with this. I mean, gosh, share with us about what happened to you, and and then give us a timeline of when you started making the shift over to the multifamily side.
Sure. So thanks for having me on, Tim. It's great to reconnect with you, man. I think we met in 2006, 2007, and back then we were doing a ton of wholesaling and flipping short sales and single family properties. We were already into pre-foreclosures well before the 2008 crash. We became one of the leading experts of pre-foreclosures and short sales. Me and my buddy Greg, who I'm still close with and still talk to often, we were just killing it with that. We were doing 100, 150 short sale properties a year. In 2011, what happened, Tim, was I was a normal day at work, pretty normal. Came home from work. I had a 2-year-old and a 1-year-old. My wife was also 8 months pregnant with my third child. And I was kind of roughhousing with my girls and playing with them on the floor. I rolled over. I turned around. I looked up at the ceiling. I'll never forget this. I crossed my hands across my stomach, and I felt this giant lump on the left side of my stomach. And just like that, my entire world changed and will change forever. Turns out that I went over to my wife and said, "Hey, honey, come check this out." I went to my buddies that were doctors. They said, "Hey, it's not a hernia. This is something you need to get looked at." But my wife was 8 months pregnant, so I waited till after our son was born. Son had a couple complications. He had a quick surgery as well on his neck after he was born, but he was within about 2 or 3 weeks. He was in the clear. So I finally went. My son was less than a month old. Got a CT scan on a Thursday. Actually, it was a Thursday. I was supposed to go. The doctor canceled last minute. I went on Friday. Got the call Monday morning, and the person, whoever it was at the hospital, said, "Josh, you got to have to come to the hospital right now." So 8:30 in the morning, Monday morning, I knew something was very wrong. Turns out I was diagnosed with pancreatic cancer. For those of you that don't know, pancreatic cancer at that time had just a 7% survival rate.
Wow.
And shortly after I was diagnosed, I learned that I had the same exact diagnosis as Steve Jobs, who was struggling with pancreatic cancer and passed away right after I was diagnosed. So I knew that I had a big uphill battle. About 2 months later, Tim, I ended up going in for the surgery, kind of got my kind of financial affairs in order. And I didn't really realize what I was up against until about a week before the surgery. You have to sign that disclosure form, like an electronic signature that you have to give to the hospital that says that all these things could go wrong. And then it just hit me like a ton of bricks, that this was really serious. And I probably wasn't taking it as serious as I should. But I quickly realized I went in for my surgery. It was a 10-hour surgery. The surgeon, Tim, took out pretty much all my insides, my gallbladder, my spleen, my entire stomach, most of my liver, most of my pancreas, had to rebuild the arteries behind my pancreas. And to put this in perspective, on the operating table that day, as you and I sit here, Tim, today, we each have a certain amount of units of blood in our body. We have 7. Most people have 7 units of blood in their entire body. On the operating table that day, they cycled 21 units of blood.
Oh, wow.
Through my body that day. And so as I sit here and speak to all your group, I have everybody's blood in my body but my own. And so it's an amazing story. But from a business perspective, Tim, when I came out of that, I also realized that I'd made a massive, massive business mistake. I was very transactional in my business. I owned a brokerage. I was wholesaling short sales and doing a lot of fix and flips, and was very transactional. Over the next 6 months, I barely worked, which also means that I didn't make any money. And so when I came out of that surgery, I made a commitment that I was going to learn everything I could about private money, because the one thing I did right before that surgery was I bought a couple properties. I bought them with private money. I brought in a contractor, and I brought in a friend of mine to kind of be my boots on the ground. And I was able to successfully flip those properties using private money. And I only saw the properties 2 or 3 or 4 times. And I thought, hey, I made this big pile of money, this big check, but I really didn't have to go. This wasn't very transactional. And why did that work? And it was because I controlled the capital. So I tell groups now, funding equals freedom. And I'm not talking about bank financing. I'm not talking about institutional money. I've worked with family offices. I've worked with, very, very wealthy private investors. It's not really about those large institutions, Tim. It's about the mom and pop retail private lender that's going to fund the 10 or the 20% of your deal that the bank and the institutions won't fund. That is where the freedom comes in. That type of capital is the most important. And so my surgery taught me to focus on that type of money. And since really the last 10 years, because I focused on that, I truly am free. And there's a whole bigger story to it, which we can get into, but that is the ultimate lesson, is that funding equals freedom. I do not subscribe to the theory of find the deal and the money will follow. I do not subscribe to that at all. I subscribe to raise the money first, warm up the capital first, and then you have an unlimited amount of inventory and deal flow that you can run after. And I've learned that through this crazy experience of fighting pancreatic cancer. And so that's really the ultimate lesson that I want to get out to your audience. And I wanted to start with that, is that funding equals freedom. And it's the last piece of the stack that's the hardest to get. It's the most important. So focus on that.
That's amazing. I mean, yeah, hearing your story just give me goosebumps. What you've been through, and it's amazing your comeback too of what you have been able to accomplish since that event. And I know that you mentioned about private money. I know you've raised money, both for private money, like for individual deals, debt based, as well as syndications, and you also raise money for your own hard money lending business as well. So yeah, so love to hear. You mentioned private money. How has that been different for you? And when you went to raise for syndications, did you have to find new investors? Were you able to convert your existing private lenders into syndication deals?
Yep. So the way this happened was very natural, Tim. I went from this pre-foreclosure wholesaling to realizing that I wanted to control the deal by getting private money from true private investors. And I raised, like $1.5 million, and we bought, 8 or 10 rehabs. And then as we did that and we got more exposure to more investors and we started doing more events and more podcasts and more internet marketing, we had a lot of people coming to us and we were meeting them and talking with them. Then I realized like I didn't want to do 30 or 40 rehabs at one time where I was responsible for the construction. I didn't want to do that. So then we created a fund and we became a private money lender and hard money lender for residential and for small balance commercial, which was under $5 million. So we brought about $40 million into a fund and we were lending it out. We were charging points and interest and we got a management fee. And so we did that in a fund structure. We did that through a 506B and 506C federal securities exemption. We had two separate funds with two separate structures. Then what happened is that out of those deals, we started doing a lot more private money lending, recruiting the capital into the fund and then lending it out to some investors that were buying multifamily. So we were now lending for their deals. I got to underwrite their deals. I had no experience in multifamily at all at that time. I had only some duplexes and some quads and some things I had done over the years, almost all single family. But I got to underwrite them. I got to look at cash flow. I got to look at net operating income. I got to look at T12s and T3s and rent rolls. And then I got to either lend out of my fund or broker for other people. There were a couple of groups that were brokering for, got to broker for them. And I had to package up I brought in a full-time underwriter. We had to package the deals up and then we had to basically sell them to these banks or we had to fund them ourselves. So it was a very natural evolution. So now I survived cancer in 2011. I don't work until 2012. From 2012 to 2014, just did a bunch of big rehab flips. 2014, we start this fund. And the fund now we have a vehicle to recruit a ton of capital and start to lend at scale, where we had over 200 open loans at one time.
Wow.
On both residential private lending, hard money lending, and small balance commercial, all at the same time. Then what happens, Tim? The evolution continues. And some of those investors that we were lending to said, hey, we would like to scale our business, but we don't have any equity. Josh, where are you getting all your investors from? So I said, well, hey, like, how much equity do you need? And so that some investors started coming to us with these amazing apartment deals. And we basically started doing co-GP, co-syndication before anybody talked about it. This was all the way back in 2016, 2017. Now it's the rage. Everyone talks about it. We started doing this. We didn't even really use the word co-syndication back then. We just were like, hey, we're a GP, we're an investor. We're also going to bring some of our own capital, other people's capital. And so we started just introducing our current investors in our fund to these syndications. And then evolution continues where we decided to say, hey, I think some of these investors that we're co-GPing with, co-syndicating with, they're onto something. But we had done a 730 unit in Atlanta. We had done a 216 unit in Lawton, Oklahoma, a 200 unit in Mobile, Alabama. We became owners in all these deals. Another 1,000 units outside of Atlanta in Albany. And then it got to the point where we're like, you know what? We should really be taking all this horsepower and just do it ourselves in our own backyard. So we made the decision back in 2018, 2019 to start buying our own buildings and owner operating them, managing them. And we no longer did co-syndication. We were just syndicating our own deals. And then COVID hits, right, Tim?
Yeah.
So COVID hits. And when COVID hits, we decide to stop lending altogether out of the fund. And now we have this $40 million that we've raised in the fund. The fund starts to slowly wind down, which means we begin to continue to wind up the apartment investments and just moving investors from the fund into these apartment deals. As of today, we've done 19 syndications. We've done 4,500 units. A couple of years ago, we sold off 1,500 units. So we're sitting on 3,000 units today, almost all of which we own or operate in our backyard. We do the construction, all the value add improvements. We bring in third-party management, but that's the evolution. And so if you're a listener on this show, or you hear this recording in the future, one of the things I wish I had done was gone right from 0 to 200 unit deals. I wish I had just gone for the big stuff, but that's really not how this business works. That's really not the natural evolution. The natural evolution is go from resi to buying a 25 unit or a 50 unit, go from a 50 unit to an 80 unit, go from an 80 unit to a 100 unit, go from a 100 unit to a 200 unit, and then do a whole bunch of 200 unit deals. And then you'll build up to these 3,000 units like we have. It needs to be, and to me, you can't skip all the lessons that you learn in doing the small to medium deals. I learned so much from those deals that allows me now to buy these massive complexes. Tim, I have a 504 unit that we just offered on last week. It was a $45 million whisper price. We offered 40 million for it. I think the broker's nuts to ask 45 million. We offered 40, but I'm very confident now in buying a 504 unit.
Wow.
Because we bought a 25 unit and a 50 unit and an 80 unit and then a whole bunch of 200 unit deals. That evolution, I think, is what a lot of people should try to mirror.
That's amazing. So your syndication business now is your core business. Is that correct?
Core business. Absolutely.
And then your other business is your coaching business. Is that correct?
That's correct. And my coaching business, all we do anymore, Tim, is we just run a mastermind. And that mastermind is basically intermediate to advanced residential investors who also have some commercial multifamily experience. So they're kind of newer to intermediate commercial multifamily investors. My stated goal for them is to get them to their first 1,000 units and their first 10 million. Okay. So $10 million of personal net worth. So I'm trying to take these advanced resi investors and move them into being very intermediate to advanced commercial multifamily investors with a $10 million net worth. That is my stated goal with that mastermind. We don't sell products. We don't do really too many live events. We sometimes teach live events just for the sake of building the mastermind.
I see. Okay. And you mentioned you're now focusing on 200 plus units, in your local area. Why 200 plus units? It's going to be two separate questions. Why 200 units and why just your local area?
Sure. So 200 units and up, we definitely have bought stuff smaller than that. I'm totally comfortable buying things that are small. Matter of fact, Tim, I have a 28 unit under contract right now. We're going to be closing. That's in receivership.
Oh, wow.
Deals are trading in some of my markets at like 70 to 80,000 a door. I got that deal for 42,000 a door.
Wow.
So in that case, like, why not buy it, right? It's a little 28 unit. So we still buy those. So the smallest deal I've ever done is 5 units. The largest is 730. Our focus today is 200 units and up because in the greater Cleveland area, also which includes Akron, Canton, it also includes parts of Columbus. We're one of the biggest players in this area, and we can't do every deal. We can't buy every property. So we really want to focus on making a couple strategic purchases every year. Our stated goal is to buy 950 units of apartments per year. And so I'd rather buy 5 200 unit buildings than 10 100 unit buildings, just easier to manage. But we'll still buy 28 unit deal if it's the right price. Frankly, Tim, at this point, I'd rather buy 2 500 unit deals if I could get my hands on. So that's why it's just, again, the ease of management. Why we're investing in our backyard is 2 reasons. I have 2 markets, and all of you need to have this. Every single person that listens to this, my advice is have 2 markets. One should be a cash flowing market, a stable cash flowing market. That's Cleveland, Ohio. It's stable. It doesn't really grow a ton. If there's a recession, it doesn't go down a ton. It's just real stable, and it's my backyard. So we can do heavy value add. We can do a lot of construction, and we can force the appreciation by forcing the rents. So everybody needs a market like that. Secondly, you got to have a growth market. For me, the growth market is Columbus, Ohio. Columbus, Ohio is a lot like the Sun Belt. It's a lot like Dallas, Fort Worth, Houston, Austin, Orlando, Tampa. It's a lot like these growth markets in Phoenix. There's so much technology in Columbus. I don't think many people know this, but out of all of the cities, major cities that have new project starts, Okay. New project starts would be like an industrial building, a new multifamily, a new business. Columbus is number 8 in the country for major markets with new project starts. Also, the Intel plant with the world's largest semiconductor chip factory is going into Columbus. You also have Honda, they're building EVs there. You have data centers from Facebook, Amazon, Google, all in Columbus. And so Columbus has this reputation, what's called Silicon Heartland. Not Silicon Valley, but Silicon Heartland. And so we're actively pursuing deals in Columbus because that's a growth market. So we might have to buy those at a lower cap rate, but also a lot more growth. And so less value add, less CapEx, and just more income growth, more population growth. My suggestion is every one of you needs to find those 2 types of markets.
That's good. I like that. Share with us, what's the difference when it comes to capital raising for a big deal, 500 plus units versus a smaller deal? Obviously the raise is a lot bigger. So what are you doing, to be able to raise that, a much bigger chunk of money?
Super simple answer, Tim. It's not going to find the family office. It's not going to find the big institutional investor, because if you bring in a family office or a group of doctors, or they're going to take a lot of your equity and a lot of your control. I don't like that. So I don't do it that way. So the difference between raising for a 500 unit and a 50 unit is simply the amount of time that you spend ahead of schedule, before you get the offer, before you tour the building. How much time are you spending warming up money? So right now, because the market for multifamily has really cooled off and there's this kind of adjustment period going on between sellers and buyers, I've spent the last 2 months constantly talking with investors, warming up cash. So right now we've got about $40 million of new capital warmed up to go buy the next group of buildings. And so our business, Tim, is we got 3 guys, 3 swim lanes. I'm the majority owner and CEO. I take care of acquisitions and finding the cash. I've got a partner that handles our CapEx, and I've got another partner that handles asset management. What does that mean? That means for me, I really can focus on looking at deals and raising capital, and that is it. So in the last 2 months, when things have been a little slower and the market's kind of recalibrating, I've spent almost all of my time raising capital so that I could go buy that 500 unit and all the money is warmed up. So the only difference is the amount of capital that you need to warm up. And then we can go write a $10 million check. We can go do a $10 million syndication, no problem. If I'm going to do a 50 unit deal, I might only need $1 million. It's a lot less time to warm that kind of money up. That's really the only difference.
That's good. And how do you give us your top ways that you market to find these these people, high net worth individuals with money? How do you find them, and and then share with us your warm up process?
Sure. So how do I find investors of all kinds? So I have something which I call my brand syndication system. Brand syndication system comes in 2 formats. There's offline and online. Offline could be anything from a physical newsletter to physical cards, physical Post-it notes that you're sending out to your investors, your friends, your family, your colleagues. You're going to start with those types of folks. I tell people all the time, look, if you can't raise money from the people that already know and like and trust you, you'll never raise money from a stranger. Never. If you can't convince someone that already knows, likes you, if it's a colleague, a business colleague, somebody that you used to work with, another real estate investor, friends or family, if you can't convince them, you're never going to convince a family office or a group of doctors. You're never going to convince a high net worth individual, because they're going to ask you about your track record. Okay. So just everybody be comfortable recruiting and raising money from your existing network. Okay. Now, that offline brand syndication system for me is so critical. Tim, I have this, I deliver a 3-hour talk on this, right? That I delivered a lot of different groups. So we don't have time to cover all that today, but offline to me is how I started. I started with newsletters, postcards. I started warming up my audience, sending them case studies, sending them example deal flow. And then I would follow up very simply with phone calls and just say, hey, did you get my newsletter? What did you think about it? Simple as that. And a lot of times it would turn into a conversation. Then it would often turn into a meeting or a phone call that was more business driven. Okay. So other ways to do things and recruit money offline includes physically going to events, physically going to meetups, physically going to, real estate investor association meetings, all the things that you guys already know how to do. Okay. So that's something that you have to do. Now, one of my biggest investors is a doctor group. I actually have not yet worked with them, but I know for sure they have the most horsepower. They can stroke a $20 million check, no problem. I met the CEO of a hospital network at something called the Lake Erie Landlords Association, right? This is a little meetup of 50 people. And he goes to that. And he's a great guy. He's not pompous or arrogant. He's just trying to improve himself and his family and his other doctor friends. So you could meet amazing people at those types of groups, okay? So let's set that to the side. If you've never raised a nickel of cash, start there. Now, if you want to scale, you have to scale in what I call the one-to-many concept. It's things, Tim, like what we're doing right now. You and I are having a one-on-one conversation. John may butt in from time to time, but it's a one-on-one conversation. And we are recording one piece of content that's going to go out to many, 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 many people. And it's going to be evergreen that people can watch for years. So if you look at any successful elite entrepreneur, Tim, whether they own a physical products business, whether they're in e-commerce, real estate, whether they are in plastics, whatever, they have a way to get their brand out to many people at one time with one piece of content or one sales message. It's called the one-to-many concept. And so elite entrepreneurs know that they have to be able to do one thing and get it out to many, many, many people. So how do you do that? Well, for us, it's a combination of podcasting, YouTube videos, live events, email marketing, Facebook posts, Facebook lives, LinkedIn posts, LinkedIn lives, LinkedIn groups, hosting your own mastermind. Okay. All of these different strategies warms up the top of the funnel. Okay. Now we have to point all those people to one direction, which is we point them to our investor portal for them to register. Okay. Which they do. We get about 5 to 15 new registrations on our investor portal every week. Okay.
That's good.
Now, here's where most people fall apart, Tim. Most people then put their investors into their investor portal. Then they put a deal on the investor portal and they think it's just going to subscribe. Huge, huge mistake. Okay. What we do is I put all my investors go into my investor portal, they register, but I don't know if they're accredited, non-accredited, if they're more of a 506B, 506C. So what I've committed to is that I then put all these new registrations on a 90-day autoresponder. They all get pieces of additional content. And inside of those emails has my Calendly link. They can then register through Calendly, register through Zoom. Now, this is critical. When I get on the phone with them, I have a script that I use that only works 100% of the time.
Nice. That's awesome.
Works every time, dude. I swear to God. So I just did this about 3 hours ago. I had a brand new investor meeting, guy I've never met. He heard about me from some other podcast and some book that I was featured in and whatever. He gets on the phone. And so the first question I always ask, first of all, I always take the call myself. I'm the CEO. I'm busy, but I want that phone call because the relationship is personal. it's a relationship between the company and the investor, but really it's a personal relationship between the operator and the investor, me, the operator. I want that meeting. So here's a couple tips. Number one, that meeting can be no more than 20 minutes long. Okay. You have to set a deadline that you're going to get off. You have to project that you're busy. You have to project that you only have a certain amount of time, and that's 20 minutes. That's all I've got. Okay. Number two, when they log on, I always do it through Zoom. I never share my webcam on the first meeting. It's audio only. They often share their webcam thinking that they're going to meet me and see me face to face like we are now. I never turn my webcam on until the very end of the meeting. Okay.
Interesting.
So it's access. It's access. Okay. But there's a hook to this and there's a reason for it. Okay. That's number one. No, and number two, 20 minutes, don't share your webcam. Number three, the first question I always ask is, hey, what did I catch you in the middle of today? Because remember, like they set up a random Zoom on their calendar, on my calendar. We've never talked. So I have to break the ice. So what did I catch you in the middle of today? And they'll just tell me something. Okay, whatever it is, breaks the ice. The fourth thing, you have to ask them, are you an active investor, a passive investor, or both? Okay, because some people get on and they're an active investor. They just want to pick my brain for how to buy their own apartment buildings. What I'm looking for is the passive investor that wants to invest as a limited partner.
Right.
Some people do both. Like the guy I met earlier today, he owns a Jimmy John's franchise. He owns a commercial building. He owns 180 land notes. He owns a single family rental, but all he wants to do is passively invest. So I'm going to ask him, are you an active investor, passive investor, or both? Okay. Then next question I always ask them is, hey, let me share with you two buckets, two different types of investors. And why don't you tell me which one you think better describes you? Are you an investor who wants to preserve your principal, and in exchange for preserving your principal, you're willing to accept a lower return in order to preserve the principal? Or number two, are you willing to risk your principal and be a little bit more volatile in order to get a higher return? Which one of those would better describe you? And I let them answer. Okay, I don't care how they answer. Then I follow up with this, Tim, and I say, okay, sounds great. Well, I'm sure you got on to learn a little bit more. You've heard about me. You registered on our investment portal. We got on the Zoom call. What if I could show you a path that you could get both preservation of principal and the higher return? Now, you have to get people's attention, especially if it's cold, right? So I got on. What are you up to? What did I catch you in the middle of? Are you active, passive, or both? Okay. I understand now. What have they done? It tells me a little bit about them. What are they in the middle of? Are they fishing? Are they reading a book? Are they in the middle of work, taking care of their kids? Maybe they're a doctor and they just got off of a patient. I learned a little bit about them, that little nugget. I know if they're an active, passive, or both. I know what type of investor they are. Are they more aggressive, looking for higher returns? Are they more conservative, looking to preserve principal? And then I smash them in the face with the question and the answer that says, what if I can show you a path to get both? And now I completely have their attention. I completely have I'm going to get their time. And now what I've done is I'm now bumping Tim up. I'm bumping up against my 20-minute timeline. And now, right when they think that I'm going to pitch them, I have to sign off and get off the call. What does that do? It creates a sense of urgency. It creates a sense of want. It creates a sense of, oh my God, what does this guy have? He's asked me a bunch of questions. He was super cool about it. He didn't sell me anything. He was really, really busy. I left them hanging. So it's all the stuff that, Tim, you and I learned about in that book, Influence, right? Robert Cialdini, 10 years ago, that you and I talked about in the masterminds that we used to be in. I apply all those principles in 20 minutes, and now they want more. And I never am available the following week. The second meeting is always 2 weeks out.
Oh, wow.
Because again, project that you're busy, project that you have a full schedule, project that you're a busy business person. So, hey, man, I'm looking at my schedule. Man, next week's already full. So how about we meet 2 weeks from now? So what I find is that if you slow roll new relationships, take your time, project that you're busy, okay? Give them some time, but not a ton of your time. Set up another meeting for 2 weeks from now. They're much more interested in investing faster and much more interested in investing a lot more cash. The faster you go, they're going to make a very small commitment of maybe $25,000 to $50,000. I want investors that can invest $1 million with me over time and at least $100,000 to start. So those are a lot of the principles that I've been operating on now for 5-6 years that I've honed in. So most people, all they do is they throw the deal in their investor portal and they're like, how come nobody's subscribing? There's a big difference between that and what I just described and how it helps to raise a lot more capital a lot faster.
Yeah, no kidding. Wow, that's super impressive. So someone actually wrote the whole notes and put in the chat. Amazing.
Income holds. I love you. That's awesome. Now, here's one more tip. Let me add this one more thing, Tim. What I do is I tell investors, look, one of the things that I'm bound by, that I'm required to do, is that I'm bound by my offerings are registered with the SEC. And the SEC requires that I have a prior existing relationship with my investors before they invest. Now, most people don't use this because a lot of people go 506C. 506C does not require a prior existing relationship. They can just go 506C, go accredited. I actually use the 506B to my advantage by saying the SEC requires that we have a prior existing relationship before I show you any deal flow, before you invest. So if it's okay with you, the next time we get on the phone, I'm going to treat that meeting a lot like a financial advisor would. I'm going to ask you questions like, are you accredited, non-accredited? How much money do you make? What's your net worth? What's your goals for investing? Tell me about your family. Tell me about your kids. Are you investing for retirement, for your kids' education, diversity, all these things? And what I've done then is I've also projected that I'm not desperate for the money. I don't need the money. What I need and want is the relationship. Number two, then when I get on, I'm still not showing them any deal flow. I'm asking them questions. Another huge point, Tim, for raising capital. You have to control the conversation by asking questions. He who asks the questions is in control. So meeting number two is all about me asking them questions about, like a financial planner would. Do they have stocks, bonds, mutual funds, traditional investments, non-traditional investments, all these different kind of things. By the time I get to the third meeting, which now I'm going to show them a past deal, a past deal that I've already done, or a hypothetical deal, dude, they're so sold. They're so ready to invest. And I haven't even really shown them the deal yet because I spent the time to build the relationship. I didn't pitch them. I wasn't desperate. I postured up. By the time that third meeting comes around, it's not a matter of if they want to invest. It's just a matter of if they're liquid. How liquid are they? How much cash do they have? That process, Tim, only works 100% of the time.
That is super impressive. And thank you so much for going in such details like that. That was phenomenal. So the second appointment, how long is that appointment?
That one, I still reserve only a half hour. And they already know it's coming, and I have a series of questions, but it's typical stuff that a financial planner would ask. You know, again, all the stuff I just described: net worth, accredited, non-accredited, experience, goals, stuff like that. I write it all down, and then I say, hey, at the end of the second one, hey, great, looks like you're somebody that would qualify to invest in something like this. And again, my focus is just building the relationship with you. We've had 2 really good meetings now. Most of that relationship is pretty established. So the next time we get together, number 3, I'm going to carve out probably 45 minutes for meeting number 3, because it's going to take me that long to really. Now I'm going to pitch a new deal, but I'm going to showcase a past deal. And now I'm going to tell them a lot more about me. So that third meeting is a little longer.
Gotcha. And how long, is it like another 2 weeks out for the third meeting?
Sometimes that one can be a little quicker. So between first and second meetings, 2 weeks. from second to third meeting could be anywhere from a few days to 2 weeks.
Gotcha.
You can take that
Okay.
one much faster.
Right. And then I assume after the third meeting's over, the next time would just be a webinar when you have a deal that you pitch.
Yep. And sometimes I pitch an individual deal if I have one that I'm actively raising for, or it's inviting them to a webinar. That kind of stuff. That's usually the next step. After that second, even third meeting, we've established the prior existing relationship. I haven't pitched them anything, so they qualify under 506B instead of just C. I can do 506B, so it doesn't matter if they're accredited or non-accredited as long as they're sophisticated. And so then I just, do I have a deal ready to go or not? That's all I'm waiting for. Now, one of the last things I think that's also super powerful is at the end of the first meeting, make sure you give them your personal cell phone. Okay. Because again, by offering my phone number, what are they going to do? They're going to offer their best phone number right back to me. So I'm going to tell them at the end of the first meeting, hey, here's my personal cell phone. Okay. Go ahead and text me back sometime today so I've got your information, because when we schedule up the next meeting, then what I say is if there's a conflict, then we can cancel or reschedule quickly. We don't have to go through my assistant. Okay. Also, at the end of the first meeting, at about the 15-minute mark, turn your webcam on just for the last 5 minutes. So now they can put a face with a name and you offer your cell phone. Now you're closing the loop on the relationship. Okay. But you don't want to seem like, hey, I'm here. I'm so excited to meet you. Like, don't do that. You don't want to act that way, right? So for the first 15 minutes, I want there to be a little bit of mystery of who I am and what I do, that I'm too busy. I don't know if you qualify yet. Like, that's how I want it to posture up in the first 15 minutes. Then it starts to soften, showing my webcam, giving them my cell phone number. Those are really important.
Dude, that's so phenomenal. Yeah, I love it. Absolutely love it. And I assume this, you teach this stuff in to your mastermind members. Is that correct?
Yeah. Yep. With my mastermind members, I did my first live event, Tim. It was a virtual live event back in January. First one I've done in 5 years. I haven't done.
Oh, wow.
And so I teach this at the live event, but we only have so much time even at the live event. So with the mastermind members, we have about 100 mastermind members. I really do a deep dive with them on creating this whole funnel, this whole process. Because look, if you're going to buy any substantial multifamily asset, call it 5 million and up, you're going to need about 30% of the purchase price of total capital. Okay. Your down payment plus any CapEx, soft cost, acquisition fee, whatever that looks like, about 30%. So if I'm going to buy a $5 million property, I'm going to need about $1.5 million. And I want to have a lot of that warmed up before I even write the LOI, because I want to posture up with the broker. I want to posture up with the seller that I'm the best buyer. I don't want to get the deal first and then the money will follow, because that's a lot of money to raise within a 60-day closing or a 90-day closing. It's easy to raise that if you've got a lot of it warmed up. So I'm more warming up all the capital first, then going for the assets and posturing up with the broker. That's, hey, I've got the money raised. It's already warm. I can stroke a $5 million check. No problem. That's why I believe in spending so much more time on the front end with investors.
That's phenomenal. I love that. In terms of like CRM, software tools or different tools that you use, what are some of your favorites that you like? Yeah,
so we started with Syndication Pro, and I'm actually disappointed we left them. They've got a really nice product now, but when we started with them, we were one of their first users and they were building it. But SynPro is great. We currently use AppFolio for investor management. We use their AppFolio autoresponder for follow-up emails. We use Calendly. We use Zoom to book the meetings. And then through the AppFolio program, there's the DocuSign for all the private placement memorandums and subscription agreements. We use all of that. Through my podcasting, we have about 70,000 email subscribers. We use Infusionsoft, we use MailerLite, and we use ActiveCampaign. We have 3 different lists with 3 different types of the way that we handle those lists. So Infusionsoft, Active Campaign, and MailerLite. Active Campaign is the easiest one to start with because you can start with a really small investment, small amount of money, small email list, and grow it over time. So we use all of those tools, our tools that we're using. And then I think it's really important. Podcasts are great. Shows like this are amazing. But if you can actually schedule up like a half a day training for your private investors, or a live event that you even charge money for them to attend, now you're really putting yourself on a pedestal, right? And so that type of edification of a live event or a longer training that you invite people to, that's critical, because we'll do a live event to teach people about multifamily, and the amount with no intention of raising private money, and the amount of private money that we raise from that is crazy, because we taught people the whole system, the whole business. But anyway, Tim, those are some of the tools that we use.
That's awesome. I love that. Which reminds me, I know you've been in the education space for a long time. Your podcast has been around for a while. I think you kind of rebranded for the multifamily space, right? I'm curious. I'm curious if you were able to convert a lot of your single family audience from all of those years over to this multifamily side.
Absolutely. Yeah, no question about it. They saw my growth. They followed my path. I was very honest with them. I told them the shit that went bad and the things that went good. And now there's still a pretty fair amount of our followers, subscribers, and people in our mastermind who are like, yeah, Josh, I bought 40K flips from you back in like 2013, and then there's also new people that are coming in all the time from the podcast and from some Facebook ads that we run. There's new blood all the time as well, but we were able to convert a lot. There's a lot of folks that have built some trust and some loyalty with me over the years. And they've stuck with me, and now they want to pivot into multifamily. So absolutely.
That's phenomenal.
Hey, Tim, can I ask a question that ties into that?
Go ahead, John.
Josh, I love this because, for years and years, you've been in what I call selling the trinket and doily stuff, the info space, like I've been, right? But you were able to do something that we all want to do, which is get out of the info space. But as you're talking about your strategies and how you're positioning certain things, my info space goes off and goes, oh, I could see doing this for an offer or for a course or whatever. Certainly, did you find that your extensive background and years of creating hooks and offers and info product stuff and marketing really helped you in how you strategized, how you were laying this out?
Oh, no doubt. When I looked at the mastermind, what I decided to do was just cut through the offers, the funnels, the tripwires, continuity programs, and just say, hey, for now, I'm going to cut that out. I'm just going to offer this mastermind. And through the mastermind also include like 2 coaching calls a week. And then we were also trying to connect people that they would partner with each other. So the mastermind became an ecosystem for partnership. Really because, commercial multifamily deals are big enough that you can easily share some of the general partner or limited partner with lots of people. The deals are big enough. It's a team sport, as a lot of people say. So we said, hey, we're going to form up this mastermind to do deals. And I was very adamant about that, John. I was very adamant about that, doing this mastermind to bring in people who want to do deals. So we did 1 call a week, and we still do 1 call a week as an underwriting call where the members are required to bring deals to me, and we collectively underwrite them. We share them. I'll poke holes in them, and I'll give them advice about what to do to go back, and go offer on the deal or go write an LOI at this price or that price, or here's some things to research. And so it became a mastermind of active and passive investors, not looky-loos or people who are maybe going to think about doing a deal. The requirement was, you better freaking bring some deals to these calls every week, or I'm going to be pissed off that I don't have a deal to review. Okay. So That was how I started originally, because I didn't want to build funnels. I was just like, I have this audience, I'm just going to pivot them into a mastermind. Now what we've done is we said, okay, well, there's a lot of people who don't really want to jump into a $10, $20, $40,000 mastermind. They want to learn some of the material first. And so we do live events now. We did our first one back in January. We charged $200 for a ticket. And we did Facebook ads and a bunch of Facebook ad retargeting, those kind of things. We used my email marketing list. We did that kind of thing. And we sold about 200 tickets at $200 a pop. And what I love about it is I do it from home in my sweatshirt, just like where I'm at right now. And I have access to everything in front of me. So no travel, no cost of that, sleep in my own bed. And I also loved it. At the last event I did back in 2018, I almost missed my flight to Vegas. And we had invested like $100,000 to put the event on and pay for the room and the AV and a guest speaker and then all of my staff, and we all had to fly. And then there was this massive storm and I almost didn't make it. I got into Vegas at like 1 a.m. I got 4 hours of sleep and I vowed I'll never do that again. So I love the virtual events to teach and record, and then the masterminds for face-to-face. Now, one more thing that we're adding now to kind of reverse engineer the funnel is we're adding in a book. So I took the recording of my live event and I have a writer that's helping me co-write a book from that. I've got a little mini course on the perfect multifamily investment, and people can opt in and get that for free. And so we're building a little bit of an email marketing list to then round out the funnel. So I'm using some of the strategies that we've been talking about, the three of us for years, but ultimately that all leads down to one path, which is a mastermind of people who are doing deals. I don't really want to be a coach anymore. I want to be around people closing and buying assets. That's where the real money's at.
That's awesome. Love that. So where do you see, you've been in the market for a long time. You've been through the last market crash. You've been a lender, so I'm sure you know a lot of insights into, the whole mortgage side of things. Where do you see this market going?
Okay, so when I look at what happened this past weekend with Silicon Valley Bank, what does that remind us of?
Lehman Brothers.
Yeah.
Well, back up one more step, right, Tim? Lehman Brothers, you're onto the right thing. What it reminds me of is Bear Stearns. Bear Stearns was the first investment bank to collapse. And everybody was like, ooh, wow, that's weird. And then it was not till months later. Prashant in the chat box put Bear Stearns the first domino. Okay. So was Silicon Valley Bank the first domino? So that's what I'm keeping my eye on. But how is this going to impact me? Right? These big banks failing, I have no control over that. We have no control over that. We have no control over government policy, fiscal policy, the Federal Reserve. All we can do is react or try to get in front of it. So for the last 6 months, or actually the last 5 months, we haven't bought anything. We've actually been awarded 5 major apartment complexes, 5. And we've told the brokers, thank you, but no thanks. We actually don't want them. We're not gonna take them. One of the buildings that we offered on, we were awarded the deal at 12 million. Broker just called me 2 weeks ago and said, would you guys buy it for 11 million? And I said, let me think about it and let me get back to you. I told him, we're going to wait it out a little bit more. I think we're going to end up getting that deal for about 10 to 10.5 million. I'm waiting for it to come. There's another deal that we're currently working on right now, $45 million whisper price. And there was a buyer last year at 45 million. They didn't close. And I think the broker thought we were going to look at that deal and just offer 45 million. I told him my max was 40, and you could hear the crickets on the phone because we're a major buyer with major horsepower. And I think he thought, shit, man, if Josh and the Freeland guys are offering 40 million, like they're a really legit buyer. They can buy a $40 million asset. If they're only offering 40, like crap, like I think things are going to get worse. So here's what I think is going to happen. There's a lot of multifamily investors who bought properties over the last 2 to 4 years on floating rate bridge debt because they could get the most proceeds. A lot of that stuff is going to term out. Their interest rate caps are going to have to get recapped. It's going to cost $1 million, $2 million. Their interest only loans are going to turn to amortizing. That's going to hurt. They're going to turn into assets that looked amazing on paper that are not going to cash flow. And those assets are going to swing around and retrade over the next 2 years. So right now I am absolutely keeping tremendous amounts of dry powder. I'm warming up tons of investors. I'm going to be super selective. And I feel like there's going to be some major assets to buy that are in some sort of distress. Now, the banks are not going to push these into foreclosure. They're not going to push these into receivership unless there's some fraud. Okay. The only time they'll end up in receivership or foreclosure is fraud. Other than that, the banks are just going to kind of work these out. They're going to work the deal out. They're going to buy the operators some time. They're going to maybe extend the loan for 6 months, or they're going to recap the loan, but for a little bit less money. They're going to try to work it out because the lender doesn't want to take back a $50 million, a $20 million, a $10 million, an $80 million asset. They're not in the business of owning that stuff. So they're going to work it out. So it's going to have to be a kind of a wait, like just a kind of a waiting game, looking at a lot of offers, a lot of deals, maybe lowballing some of them and just seeing what happens. Right. And then from there, securing, here's where everybody's going to get into trouble, where they did not secure longer term debt. And when I say longer term debt, I'm talking about 5 years or more. I'm talking about permanent Fannie Freddie HUD or bank financing that has 5 to 7 and 9 year terms on it. Okay. People lost sight of the goal of commercial real estate. The goal of commercial real estate is not to get rich tomorrow. It's to get rich, period. At some point in your life. It could be 20 years from now. It doesn't matter. If you just buy the shit and freaking hold on to it, you're gonna be freaking rich. Tim, I met a guy a couple of years ago. This is one of my motivators. I met a guy a couple of years ago. His name was Turk. And Turk got out of his Cadillac, met his property manager, and got in to his pimped out golf cart. And the property manager and Turk drove us around to his property that he wanted to sell. When we walked out of that building, I made an offer on it. We ended up not getting it. Somebody else actually beat us out on that asset. But I found out later that Turk had a $95 million portfolio that was paid off.
Wow. It's awesome.
Right? So Turk developed the real estate. He was actually the original developer that built it, and he just freaking held on to it. Now he's whatever, I think it was about 70, 75 years old. He got a $95 million portfolio that cash flows like crazy, that's paid off. His kids, when he dies, will get a step up in basis. They'll pay no taxes on it. And look, do I want to have massive amounts of cash flow now and be rich today? Yes. And we've done amazingly well. But ultimately, the legacy is when the day you die, what do you leave behind?
Mm-hmm.
Your kids and grandkids and people that you love, your charities, your universities, high schools that you want to leave money back to. That long-term approach is the only approach for commercial real estate and for raising capital, right? If you have a get rich now, you are absolutely lining up. You're playing the wrong game. That's like trying to play football with a baseball bat. You can't do it. Okay. So from that perspective, Tim, like you've got to have this long-term approach. That's what's going to happen with the market. And that's why the stuff that we've bought over the last 3 to 5 years, we put long-term debt on it to get through a time exactly like this, where we don't have to refi or sell anything till 2025, 2026. I'm going to sleep well at night while all these other jokers that are like, oh my God, I bought 1,000 units, but they did floater loans. They're going to get murdered in the next 18 months. That's what's going to happen.
Wow. That's great. Great insights for sure. Great perspectives. All right, Josh, we're going to wrap up this part of our interview today, and then we'll go into the Q&A in just a little bit. But before we wrap this up, for the folks that wants to reach out to you, learn from you, partner with you, invest with you, where would you like to send them?
Sure. Our main website, freelandventures.com, freelandventures.com/passive/portfolio/everything is all the things you'll find. You'll find our portfolio there, limited partners, active operators, mastermind, blah, 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 blah. Go to freelandventures.com. You can poke around there. And then I'm all over Facebook and LinkedIn. You can check with me there as well.
Awesome. And I have one last question for you here. You've been so generous in sharing like really good stuff with us today and great details. How can we give back to you? What can we do for you?
Look, man, I think it's like, listen to my podcast, subscribe to my YouTube channel. Because like when I got sick, and I realized that I had a message, I had a story to tell. And a couple of years ago, I really started pivoting, from resi to multifamily back in 2017, 2018. I just get such a kick out of when people listen to my stuff, engage in my stuff. I record a lot of solo casts. I just tell stories about what I'm actually doing. And when people get on and then I maybe get a one-on-one call with them and they're like, oh my God, I heard this story that you told about this thing at this property. That just really gets me. I mean, I'm very fortunate. We have a huge portfolio. We've got lots of private investors. So I don't really have a big need other than like engagement and relationship and like those kind of things. That's what's important to me in the second half of my life. When I got sick and my dad said, look, you were spared for a reason. He said, the second half of your life, Josh, your only goal is to find out why you were spared. So I don't know what the answer is to that yet, but I do find the answers when I meet new people, when I engage with new people, when I have fun with new people. And so I like to be out and talking to people because that's ultimately the legacy that we all leave is relationship. So that's pretty much it.
I love it. That's awesome. Yeah. So folks, go check out his podcast. Website is freelandventures.com. Correct. Check out his podcast, check out his YouTube, subscribe, share it with your friends and family as well. Thank you so much, Josh, for doing this interview with me. Really, really appreciate you.
Absolutely, Tim. You're the best, man. I'm so happy.